we are gonna talk about the new insurance policy evaluation feature within the ManageXValue Risk Quantification platform. However, in order to understand how to enable insurance policy evaluation in a flexible way, I just want to provide a quick reminder around the importance of the Risk Quantification Graph Model that is behind this platform. This graph model enables us to look at the overall risk landscape of the organization on an aggregate basis. For example, looking at the loss exceedance curve for the overall business. However, given the graph model behind it, it is also possible for our clients to slice and dice the information in any way. So they can focus on the direct financial impact of all the risk events, or if they want to, they can drill down into very specific risk events, such as the loss of investment banking client data. If we apply the filter, now the loss exceedance curve really just reflects the risk profile of the specific risk event and the specific impact areas we defined. This slicing and dicing capability is crucial in order to really have a flexible insurance policy evaluation. And let me show you why that is the case. So in this case, you can see there are two relatively simple insurance policies defined here. Both of them focus on client data loss. One of them just the consumer banking client data loss event, and the other one is the investment banking client data loss event. When we look at a specific policy for which there is a certain annual premium paid, it is possible that it would be a complex policy with multiple coverage areas. Clients can define up to 10 coverage areas, but for simplicity purposes now we just define one. When you define a specific coverage, again, the slicing and dicing capability of the graph model come in handy, because you can define any threat areas that you want the coverage to focus on, like cybersecurity threats. You can focus the coverage to any specific attack surface that is targeted by the threat actions. Or such as in this case, you can define very specific risk events no matter what type of threat actions resulted in those risk events. And of course, if you have a larger business or organization with multiple business units or reporting units, you can define or specify what part of the business you want the coverage to focus on. You can define the copay or annual deductible or risk event deductible, the risk event payout limit, and of course the annual payout limit. Now the last area that is very important from an insurance perspective is really defining the coverage of the impact areas. You can potentially define different insurance limits also. Similar to your car insurance, for example, if you have a windshield damage, then you have different deductible and payout limits than if you have a body limit. But what is more important from an enterprise risk management perspective is that when we define the risk for an organization, management teams can define specific non-financial or non-directly financial impacts, or in other terms strategic impact areas that can be very relevant in terms of really evaluating the risk for the organization. This can be something like the loss of customer trust, which is a longer term impact coming through in an uncertain timing and uncertain magnitude of impact, but still relevant for the decision makers, or loss of regulatory trust. Of course, the challenge is that there is hardly any, or if any, insurance provider who will cover these type of costs. They really focus on very specific direct financial impacts that are easy to quantify in case of a risk event. So you need to define what is the impact area that is covered by the specific coverage. Once we have all that information and we have the underlying risk quantification in the background, the insurance analysis becomes relatively simple. You can see here the risk transfer analysis, because often what you hear is that if you have a certain risk, high level of risk, you just need to make a decision around to what extent you will transfer that risk to someone else as an insurance provider. However, transferring is not as simple necessarily. There's no free lunch in transferring risk, as you can see here in a second. What the risk transfer analysis highlights is that there is a certain expected payout for this specific coverage, which is represented by the green area within the chart. This basically means that considering the loss exceedance curve of this risk event, then to what extent the insurance policy, considering the coverage limits, is going to pay out some of the impact from this risk event. However, in order to get access to that potential transfer of risk, you need to pay an insurance premium or an insurance cost or fee upfront to the insurance provider, and that is represented by the red area within the chart. And then if the red area within the chart exceeds the green one, that basically means that in that part of the risk profile, the annual upfront cost exceeds what the annual payout would be. So in this case, the expected annual payout is a little bit less than the annual upfront cost. So the expected excess payout is a little bit negative, but close to zero, which basically would represent that the insurance policy is priced at a fair value, because zero would be the fair value, in which case the expected annual payout is approximately the same as the annual upfront cost. Of course, this is on an expected basis, so there is the Monte Carlo simulation behind it. However, every year could be different. And related to that, there is the excess payout likelihood information that can be very relevant to consider. This shows here, in this case, for the specific risk event, that there is only a 38% chance or likelihood that in any given year, the insurance provider will pay out more than the fee that is paid for that specific insurance. However, even though it is a relatively low chance for an excess payout, the amount of excess payout could be pretty significant. It is because the cost of the insurance is $13 million, while the potential maximum annual coverage is $50 million. Now, if you compare this insurance on the consumer banking client data loss to the investment bank client data loss, what is interesting is that the coverage is the same. However, the annual upfront cost or the premium for the insurance is significantly larger. Instead of 13 million, it is $43.4 million. And it is actually close to fair value, because considering the risk profile and the coverage for this risk event, actually the expected annual payout is almost the same, $43.4 million. This happens because this is a very risky area for this organization. And in fact, in any given year, there is 78% chance that the insurance provider would pay more than 43.4 million out to cover any of the risk events related to this area. However, even though it would be very likely that the insurance provider would pay out more than the cost of the insurance, this excess payout is pretty limited because the 50 million annual limit is very close to the overall cost of $43.4 million. Having said that, the beauty of the insurance policy valuation really comes in not just in terms of evaluating your current reinsurance policies, considering your current risk landscape, but it enables you to consider the impact of any of your investments or portfolio of investments, and then how that would impact the current insurance policies. So for example, if this organization executes successfully this investment that focuses specifically on the mitigation of investment bank sensitive data loss event, which is the coverage of this insurance policy, what you see here is that the risk profile of this risk event goes down significantly as a result of the investment, as a result of the improved strengths of the protective capabilities against this risk event and the specific threats that can result in this risk event. And the expected annual payout drops to less than 10 million compared to the annual upfront cost, which results in a negative $33.6 million excess payout. In other terms, once the company executes this investment, then the insurance policy becomes overpriced. There is an opportunity in this case to decrease the annual premium by $33.6 million in order to get back to the fair value or the fair price for the insurance policy. So this is what I mean. It is very valuable for clients to really have discussions with their insurance providers around what type of risk mitigation investments they are going to do, how they are targeting the specific risk areas that is covered by the insurance policy, and as a result be able to negotiate around the insurance policies or changes to the insurance policies. Similar to or compared to the previous 78% chance for an excess payout, now this drops down to 10%. So even from this perspective, this highlights that the insurance policy could drop in terms of price. That is, of course, a significant potential savings for the company if they can materialize those savings with negotiations with the insurance provider, and that can actually add to the return on the specific investments. Of course, if there are multiple investments the company actually considers or plans to execute, even though we will get into the portfolio evaluation details in future videos, what you see, it enables you to look at your risk landscape over 10 years, over time, and then see how those investments, as you execute multiple of them, will change the overall risk landscape, and specifically in this case, the risk profile of the specific risk event that is under the coverage. And as a result, see how the insurance policy could potentially be repriced every year, considering the changes to the various investments. So that is very, very useful feature for our clients in order to help their negotiations with the insurance providers and considerations around risk transfer. Of course, once you define multiple insurance policies, it is possible to combine and evaluate them together. So in that case, looking at the current risk, what is the overall payout and the expected payout relative to the annual cost of those combined insurance policies, therefore to what extent all the insurance policies actually provide an opportunity for risk transfer, or if any of the investments are executed similar to the previous one, then you can analyze how that changes the risk transfer analysis. So all of this is a new feature for our ManageXValue Risk Quantification platform, and it is another aspect that helps clients to manage their risks effectively and efficiently. I hope you like it. If you have any questions around this or any other features of the platform or any other capabilities, or you are interested in a demo of the platform, just head over to ManageXValue.com and request a demo, and we would be happy to provide you one. Thank you very much.